The everything crash has officially started, with the Bank of Japan raising its rates for the first time in more than 17 years. Yes, folks, US stocks and global markets are crashing in overnight trading after the Nikkei 2025, which is the Japanese stock market, has plunged more than 7% in a single trading day. This is quite literally the worst performance for Japanese markets since 1987 and is triggering a global rout for every asset. This is truly unfathomable, as the Nasdaq has fallen into correction territory and the S&P 500 has erased more than $200 billion in value in just 3 days. Crypto is plunging, as well as expectations of a Fed pivot. On top of what we already saw with the triggering of the SAM indicator last week, indicating an impending recession in the United States, Japan's own poor policy making by the Bank of Japan is resulting in potentially a bottom signal. Now, as for why that could be the case, let's have some context first. You see, folks, Japan has struggled with poor inflation for a very long time. They are struggling to grow, whereas the United States is struggling to slow down its growth. It's a complete opposite picture of what's happening in the West, what's happening in Japan. Their interest rates have always been lower than other economies and has been nearly negative to zero for more than 25 years now. This is a stark contrast to what was happening in Japan up until 1980, which was a big economic boom with manufacturing as well as extreme investment in the country, which boosted stock prices and investment. But since 1990, Japan has struggled to regain its dominance force and struggled to even increase wages or increase prices at the benefit of the consumer. And all this has resulted in Japan having some of the worst debt to GDP ratios in the entire world. The Japanese government's yen has lost value like nothing else over the past 20 years, making it extremely easy for the government to buy back its own bonds. For years, people kept buying the yen, converting their conventional currencies into something that is worth a lot more compared to others, which is exactly what is now starting to unfold right now. What happened last week is that the Bank of Japan raised interest rates from 0.1% to a quarter percentage points for the first time in recent history. This was not expected by anybody in the entire economic forum, which is exactly why it's sending shocks across global stock markets. The risk now is that people are going to pull money out of their investments and back into the Japanese yen in fears of a potential bank run. Because what's happening now is a repeat of what happened to the United States in 2022, when Jerome Powell raised interest rates for the first time in a long time, causing stocks to crash and risk assets to plunge. And although markets aren't agreeing with this, this might actually be a good thing for US stocks. Because think about it this way, folks. The recession we've all been waiting for never materialized until now. The yield curve is finally starting to reinvert, which has always historically preceded a recessionary quarter. And as you can see by this table, the SAM indicator also coincides with the recession, meaning there's a higher probability that this quarter and the following quarter in the United States are going to be of low to negative growth. And as much as this sucks for any other economy, it isn't as bad for the United States given interest rates are already at 5%. And the Federal Reserve is already under pressure to reduce that and spur growth, as all leading indicators have already shown us we're headed towards a recession. What's happening here with Japan is potentially exactly what the government in the United States needed as a trigger indicator for reducing interest rates and potentially pursuing quantitative easing. The fact of the matter is that the S&P is up 12% for the year, and the Russell 2000, which is small businesses, is underperforming significantly compared to what the S&P has been doing. Big tech stocks have dominated markets because of AI, but Main Street has been struggling. Companies are still tackling with inflation, and we have seen significant amount of bankruptcies at record levels so far this year. Risk assets are struggling, and manufacturing has contracted for a long time, as seen by the shipping and transportation sector performances in North America. These are leading indicators of economic performance, and the Fed has been ignoring this for a long time in its effort to bring down inflation ahead of the election. But now they might finally have that trigger signal and that excuse to bring the interest rate down and spur a little bit more economic growth ahead of the November election. As controversial as what Bank of Japan has done, and as much damage as it might do to some stocks, it is potentially a positive signal for U.S. economic policy. As usual, folks, let me know your thoughts on the situation down in the comment section below, and thanks a lot for watching. Take care.